90% of the time. It's not often you see stats like this in the markets, but in today's video, we'll be talking about what triggered over this week, and more importantly, what's ahead for historically the worst month of the year. Yes, we're in September. So with the S&P 500 in consolidation range, with the NASDAQ falling behind, and the Dow Jones making an all-time high, what's really going on? Well, a lot of it has to do with breadth, and it looks like the market might be improving underneath the hood. Then there's, of course, the bear thing, though, and it all comes back to the bonds market. We may be on a ticking time clock very soon, with yield uninversion possibly only a few days away. Join us, guys, as we go through stocks, commodities, and cryptos in the special weekend edition of The Daily Show. Well, welcome back, everybody, to the special weekend edition of The Daily Show. My name's Tom, and in today's video, we'll go through everything from the macro to the data to the lead indicators that we need to know. And of course, there's some dark pool activity also going on along with the options flow. It was a bad week for semiconductors and a great week for the other 493 stocks as we saw breadth start to take hold. And I think that's one of the most important things that we need to talk about together in today's video, and that's breadth. We've got this chart here from Matt Seminaro over on X, and you'll notice that in September, we're faced with two paths generally in election years. Now, of course, this year is totally different, and we'll talk about that in a few moments, but we can see here that when we didn't end in a recession over the next kind of few months or even 12 months, we basically were looking at a path where markets would actually rally up and not sell down. Now, this could be something that's very interesting for us to watch because we know that there's a rate cut coming, and we also know that specifically the next 1 to 3 months of market structure following that rate cut will show us everything we probably need to know about the next 12 months. We also know that US elections tend to bring flows, and sometimes that flow is negative and sometimes it's positive. But in 2024, as you can see here with this chart I posted over on X, it actually shows that flows are the second best recorded since 2004. That's a pretty bullish sign when you think about where we're at heading into the election and how the market feels about generally maybe whatever's going on behind closed doors. A history of Fed cuts also shows us, guys, that we can expect some kind of turbulence around rate cuts, but in general, you've got to be very careful at how many rate cut percentages does the Federal Reserve place. Now, we did a survey recently, and most of you were actually saying that it's going to be 25 basis points, and this is exactly in line with what I expect. 25 basis points. If they do 50, you have to get really worried because, of course, why would they do 50 if the economy is all good like they say it is? That will show us that something is broken. And remember, the speed of the rate cuts, as we've demonstrated several times with charts going through our previous videos, so go and check those out, that really defines whether we're going to be in a terrified market, at least over the next couple of months. S&P 500 returns after the first rate cut. Of course, the ones that we well know are 2001 and 2007. But actually, the little-known ones, the ones that we're following the biggest track record with at the moment, seem to be more in line with 2019 and potentially even 1995. Remember, 1995 was also what we call a concentrated market, a market that was made up of a bubble and a market that was made up of just a few stocks taking over. And that's similar to what we've had here in 2024 so far. This is another one that's going to be important. Do we see a little bit of a dip first? Most of them do dip around the period of the rate cut, and then they tend to usually rally forward, at least in a lot of the cases. But if it starts to dip and then go sideways after the dip, that can be an absolute warning sign for all of us as traders and investors. So it's going to be a very pivotal end to the year when it comes to figuring out whether we're going into a recession according to the market or whether the market may want to go even higher. And you've got to remember, because we're in an AI bubble at the moment, each bubble always has to be bigger than the other one. Now, we're already there market cap wise, but we're not there necessarily when you disconnect from the prices. And I'll go through this using Nvidia in just a few moments that I think will blow your mind when you look at the actual valuations of Nvidia versus the averages over the last 5 years. Now, we've long argued the idea of a weakness probably is going to come through more likely than not at the end of September. And the reason you'll know this is when you have a look at this chart. Generally, the first 10 sessions and the last 10 sessions for each of the years and months is quite important. And this is a great chart for you to actually take a snapshot of if you're interested, from Bank of America, from Mike Zaccardi over on X. And you'll notice that September is the big kahuna here. Generally speaking, when you get the weakness, it comes through in the back end of the month. And I think that's quite an important stat there. 10-year minus 3 months versus 10-year minus 2 years. Now, uninversion of the yield curve is no doubt going to come. If the Federal Reserve have said to us they're going to rate cut, then there's going to be an uninversion of yield curve occurring. This is a stat that you're going to have to stick around for, because I'm actually collating some special information about what exactly happens after the uninversion of the yield, whether we're on a timer that's going to be 3 months, 6 months, 9 months, or even just a few months. One thing's for sure is generally when uninversion of yield curve happens, you do not just instantly crash the market and everything explodes, yeah? So just please be wary of that. A lot of people think that the uninversion of the yield curve is going to explode the market. I'm pretty sure we're going to get this news over the next coming weeks. And once we get it, everyone's going to say, well, that means that the market is going to absolutely get crunched. It might drop 1 or 2%. Everyone will start shorting. Historically, that hasn't been the way it is. Anyway, we'll bring the stats for that very soon, but we're getting close to that 2-year versus 10-year uninverting. Another thing that I guess is like fallacy versus truth, it has to do with IPOs. This is a great chart over on our X account. And you'll notice here it shows you market cap at IPO versus market cap today. Now, this is taken from a while ago, but I just want to kind of reiterate here, don't fall into the hype. Always look at these particular stocks, and specifically, you need to know that most of the time, big tech hype stocks don't perform well over the first 12 to 18 months. We've talked about this on the channel so many countless times, but remember, there were a few investors, anyone know in the comments down below, it'll prove where you're at, that were buying these particular two stocks, and they were buying them on the IPO day. It showed me instantly, and all of you guys, that we should never be paying attention to what they're saying, because that was the most ridiculous throwaway of money, burning it into a cash pile that I've ever seen. And those stats, you may think they're just new. They've been going all of my investment career, very similar to this. And that goes all the way back to 2007 plus. Let's have a look at this chart, because of course, this is the one that shows us a 90% positive correlation over the next 1 year. So basically, this basically means that the New York Stock Exchange Summation Index achieved a 900 plus reading. And this is a fairly rare stat. It's basically one of the most broad measures of breadth momentum when it comes to markets. And it shows us that the markets are really in for potentially a very nice run into things like IWM and, of course, the RSP. Now, we've already seen the RSP make new all-time highs. That's the equal weight market. But we've also seen IWM start to improve. And, of course, people like FundStrat's Tom Lee, he's incredibly bullish on IWM. And one of the reasons is because of the rate cuts. Then, of course, you've got just generally, if you are going into a broader market recovery from where we were in 2022, the small caps eventually have to start playing out, and the mid caps. And that's where we get Wall Street's idea. Wall Street is basically saying, we want small caps and mid caps to perform better. We want to see those guys giving us the good earnings over the next coming quarters. And if they don't, well, the market's going to go absolutely haywire. But at this stage, very bullish stat here. And you can see New York SI exceeds 900 for the first time, and all the data stats leading back. It's not like we only have a few data stats here, though. That one's from Seth Golden over on X. Labor Day to year-end performance. Hopefully you have a great long weekend if you're in the US. But in general, we do need to remember that the stats here are usually positive, so any of the pullbacks should be looked at as probably a bullish kind of counter at this point. And we also know that Wayne Whaley's brought out some great data suggesting that if we've seen weakness, it's usually going to happen in the back of September into early October. He's got a new one here, which is that when you have a 5% positive summer, that you usually have a pretty decent run actually through September. And in general, it's more positive than negative, which is actually against the stats. So you got to remember, it's actually showing September might be okay. And it's December, specifically October 18th to 28th, that we need to be more careful of. At this point, I think we'll monitor the situation. We're kind of looking really towards the Federal Reserve, because there's always a lot of hype coming into the Federal Reserve, a lot of sideways action on the S&P in particular, generally, as we see a lot of rotation up and down. And then of course, we go into the rate cut itself, giving us usually a bit of a shock in the markets and then hopefully a bullish resumption. After the S&P 500 has a monthly trend broken on the high, then what happens? Well, this is actually when a 5-month uptrend was broken and then it made a 4-month high. So in this case, again, more bullish stats coming out. Doesn't really matter how you cut it. They're tending to look more bullish than bearish. And of course, the price action on the bear side really has to be short-lived. Those gap fill potentials or something else. Let's have a look at the S&P 500 daily performance when it comes to Nvidia earnings. Now, you might think Nvidia earnings has to always be positive and amazing, but remember the S&P 500 only followed Nvidia 3 of the last 7 times. So it means it's not statistically relevant. Here's some projections of forward PE currently with Nvidia. So we're trading around 40-ish, I think at the time of this recording, 41 forward PE. That's actually exactly in the 5-year average of the forward PE itself. And if you look at the PEG ratio, that is the forward PE divided by the 5-year forecasted growth rate, it's under 1. Now, if you know anything about PEG, this is not too bad at all. So basically speaking, this is kind of where you want to have a stock if you're looking towards further growth. Now, somebody mentioned in the comment section, well, that could also mean it's just been overpriced for 5 years. Yeah, I like your approach. It's pretty funny. But as you know, yes, that's true. But our perception of what something is worth is not really that relevant. It's just what were other people willing to pay for it. And can you, therefore, navigate these markets so that you can get in and get out and, of course, hopefully make a tidy profit. Remember, your assumption of it being overpriced, there are a lot of stocks that remain overpriced potentially for 5, 10, or even I've seen, 15 years, some stocks have been totally overpriced. The biggest case one is actually bonds. If you think about bonds and where they were trading for like 8 years after the global financial crisis, they were so overpriced. And then, of course, you see what happens with treasuries. It gets absolutely mutilated. So yes, all good things come to an end, but you've got to be hopefully in it to win it and then recognize when it might be blowing up. Let's have a look here at some dark pool activity. Speaking of treasuries, we've got some treasury funds showing a couple of dark pool trades. After we had, of course, the whole funny business with Japan, we saw treasuries go ballistic up and then they've kind of hovered around this zone for a while. I would say anywhere in here is not bad buying if you've got a long-term horizon on treasuries, but it doesn't really exactly look like there's a catalyst there. Just a lot of trades going through in dark pools. I want to show you that because you can see all of the lines. And that brings us over here to BABA. Now, we've talked a little bit about China recently. We've talked about HSI in particular. And the reason I mentioned BABA is not because I like the stock, but there's been a lot of activity in it. So like a lot of other Chinese stocks, there seems to be a lot of activity the last 2 to 3 weeks. And we have to assume they're probably buyers. And you can see here with BABA that it's all around the same price. So if you put a volume profile on BABA, you'll notice there's a ton of transactions going through exactly where that is. And of course, that led on to, I think, a relatively decent gain in BABA on the stock. I don't like BABA myself. However, HSI and 700 and others have been improving, which is cool. Stock to gold ratio, interesting to state this. When you look at these types of things, when gold overtakes basically stock from a overall position standpoint, this is something you need to pay attention to. Generally speaking, it's one of those times where often your lost decade is over. So you'll notice here, this is a lost multi-decade on gold. But when these types of runs end up starting, gold can go quite ballistic. And of course, on the channel, we believe it could go to $3,000 minimum an ounce, which is something we're looking for over the next 12 to 16 months. Let's have a look here at financials and everything else. Well, you can see again, the rotation seems to be in stock area market sectors that a lot of people aren't in. Most of retail is generally in semiconductors and technology. Well, it's been a great time for financials. As we've mentioned, this is usually the late cycle style stuff that happens. Then we've also got utilities, which is one of our favorite sectors. Healthcare, which is one that's kind of a sleeper that tends to do pretty well after post rate cut environment. And then we move over to this one, which is the last 24 hours. And you can see here, semis did bounce after getting sold heavily, and consumer discretionary also bounced. So let's jump into the charts together and have a look at the S&P 500. All things considered, that was a pretty strong close for it on Friday. Not probably what I exactly expected, but we warned that this was a possibility as the market is quite strong from the breadth standpoint. Let's have a look at the S&P 500. The weekly close was pretty good, actually giving us a nice wick there. And the daily itself closed right just around that previous high. Now, the importance here is, of course, we have a coiling market. Now, it wasn't unexpected to see this, what we call a pit or a pullback in time. But generally speaking, you get a lot more wipes on these positions as they're about to go to the new all-time high. That's not exactly what it had done here. And I'm still a little cautious for it from a trading perspective, from, of course, a holding perspective. That's someone that's holding for weeks into months into a year. I have absolutely no issues with this whatsoever. I think it still looks quite bullish across the board. Now, you will notice that that is the closure. That's the most important factor here. And if we go over to the futures market, it managed to get through all of these major fibs as well. Now, on the futures market, it did make the new low. So over here, we got the low, we got the rally, we got the dump, and then we got a new rally that came through on Friday. Now, this is really interesting because what we now have is we have an options level low for the Tuesday open. Remember, it is Tuesday, not technically Monday because of Labor Day. And we also have only one last resistance in our way towards all-time highs. Now, with the breadth looking the way it is, this is actually pretty strong from the US 500. And I think bulls will be trying to buy it with stops underneath these lows down here and saying, you know what, I know there's gaps here, but we can fill those late September, early October potentially, when it comes to the Federal Reserve and the cuts that are going to be put in place. Let's have a look at the futures market. The options market kind of agree with that. Well, we'll enter into positive gamma if this does occur. So 56.50 we know has been a massive call wall for a while. It remains a call wall on the Tuesday session. And if we end up getting a movement through 56.50 into 56.75, which would be the next level it'll go to pretty quickly, then these levels here could start to feed upon themselves. Remember, positive gamma is a possibility here this week. And if you actually go out to the next session, being the 4th of September, you'll notice again, 56.50 is well struck. So we're still at technically a little bit of a call wall, like a res. But if this market manages to break out, you can see how quickly it can feed upon itself. Already by the 20th of September, we're moving into calls all over the place. 57.50, 5800s, 58.50s. There's a lot of calls in the system that are starting to come through. What stopped the market from going down last week? Well, quite simply, probably us as retail traders and hedgers. Everyone was trying to hedge Nvidia. The market obviously fell into that event. People went ballistic with hedges and they kept stacking these particular zones, 55.50. And we saw that heaps, 5600. And the market was just not willing to go underneath it. So at the moment, it's kind of climbing the wall of worry, but it's doing so with a broad-based market breadth additional. So it's everything that you kind of already expect from a bull market in terms of this next sequence of the bull market, even though I still think we're in late cycle investing, which means utilities often do well. But you can see that, that's exactly what's happened. People are freaking out, but at the same time, the actual internals are starting to do better and better and better. S&P 500 versus CTAs. CTAs are still caught behind, so they'll have to eventually buy back into the market as the market's going up. Expect that to be potentially also a ballistic thing should we make an all-time high on the S&P. And the NASDAQ is definitely much weaker across the board. Speaking of weakness, silver price wasn't the best on Friday. It started to pull back a little bit. CTAs continue to dump. CTAs are dumping on gold, which is interesting. And Brent is kind of up, down, and all around, which we have warned of. This year's an election year. Brent is like, basically oil is one of the hardest trades, I would say, to be in on a longer term hold. It's going to be up, down, and all around. Maybe good for trading, kind of bad for multi-month investing. Let's move over to Tesla and have a look at what's going on there. 215 core wall. Again, a lot of positive gamma possibilities this week, and you'll notice the same thing with Nvidia in a moment. And it's all around the idea of really, if this market does choose to break out in the S&P, well, we know 214's current price. We're so close to an all-time high in the S&P, then if it breaks out, it's going to start bringing all these stocks with it. Let's have a look at Nvidia. Nvidia is sitting at 126 as the major strike. Last week, 130 stopped it absolutely in its tracks. And that made perfect sense realistically when we looked at it. We're trading at 120, let's say, give or take at the moment. So if it gets through 126, again, positive gamma taking over. And that's the big strike. That's going to be where most people are watching Nvidia closely this week. So just before we jump into the charts and we take a look at all of the key levels that we should be watching right now, I want to say a big shout out to the sponsor of today's video, which is Tiger Brokers. Now, one of the things we love about Tiger Brokers on the platform has always been that they're constantly improving their platforms. And actually, they just won a special award from Finder that says that they are now the best mobile app in Australia. So this is a pretty big deal. And of course, if you are from Australia, you would know that Finder is a great website to win an award from. They've also been winning plenty from CanStar, and they've added some additional things that I think you guys might want to know about. Firstly, AI investing. I love looking at the news and getting the AI investing component, but we know it's a global market nowadays. So to be able to trade US stocks with a 24/5 broker is a huge deal. Access 9,500 plus stocks and ETFs. Zero additional fees to do that. And of course, these are the trading hours. So if you want to get on top of your game and start to think about markets a little bit differently, and check out Tiger Brokers in links in the description down below. A bunch of special offers, of course, for our Australian viewers, including some things that are exclusive to the FX Evolution videos. Check it out. Links in the description down below. Thanks so much. So let's have a look now at the charts and the key levels that we need to be watching this week from the major markets. First up, let's just talk about yield uninversion. Now we know we're close. We actually did partially uninvert the other day during the flash crash, but we're getting back down there again, sitting at 1.004. Now it's not so much the uninversion itself that will be like an instant sell the market and explode or anything like that, but it is a timer. And you've got to remember that the bonds market has been kind of predicting the chances of a recession for a very long time. Now, people misinterpret this particular indicator. We'll go through it soon. And they always say, well, when you invert, that means that the market's going to explode. It's the uninversion that's key. And remember, it's not instantaneous. It's a timer that starts. And there are a few different reads that we can look at. So I'm putting that together for you guys very, very soon. Let's have a look at the US dollar. It continues its movement up. Very nice. This is exactly what we would expect it to do. And the US dollar is on its way towards the daily 20 moving average. About 102 level, 101.80 will be interesting for the dollar. So I guess it's still bullish for now, and we're waiting for it to get to that zone to see whether the bears take control. Speaking of bears, the OPEC. Like, look at this thing. I mean, it's so ridiculous when it comes to oil at the moment. Obviously, we've got OPEC coming out with more barrels. They're trying to make a few bucks. And at the same time, we saw it crush this stock. Now, we were talking about this one in our previous video because it actually had an incredibly good replication trade right around here. And generally speaking, when you were adding this replication trade, you would either break even or take partial profit here, and you'd leave some as a runner towards potentially breaking through even higher. Now, in that case, OPEC destroyed it. So, of course, after that event, OPEC pushed it to a new low, and you would have either been broken even or taken, maybe half or 3/4 of your position out. Now, that doesn't mean it's a bad trade. It's exactly what you would have expected. From here to here is the most likely move. And I think, there's a few comments that were coming in about it. That's exactly what you want. And remember, that's the type of ratio, the type of entries that you're looking for as traders, because it's giving you way more than a 2-to-1 style ratio. And that's what you should be doing. For now, though, oil looks horrible. If you look at a weekly chart, that's a big rejection again. And it looks like it's trying to put pressure back on the 72 to 71 a barrel. So this is quite an aggressive move towards, of course, the downside. Let's move over to gold now. Gold also showing some weakness, to be expected. We got these kind of stop signs on one of our indicators a little while ago, and it was to tell us that basically this market is probably going to go sideways or even a little bit of a rejection. Now, it's been what we call a dull market, so very difficult to short. It's very difficult to trade unless you're trading ranges. So for now, I think the range trade is best, and we are looking towards it potentially hitting 24.83, and if it can do that, then maybe buyers come back in. Remember, that's where the daily 20 is, plus that level of demand. Silver is the same. Silver was showing a little bit of strength. Now, I would say that this actually was a fairly decent replication buy here, and this one's a failure. So when you look at trades, you've got to say, well, you're not going to win 100% of the time. Is this a good trade or not? I would do that one quite a few times over. And I would say that if you did this trade 100 times, you would probably win this trade somewhere between 65 to 70 of those times. Now, that means you're going to lose sometimes. And I guess this is a key one. Is there anything to learn off it? I would say not really, because the trend was still up. The trend had still made a series of higher highs and it had found demand. There are, of course, always problems with them, but you need to reassess that and you need to look at it yourself. Now, when you've got the demand here, I wouldn't necessarily just buy this silver level anymore. Now, we got down to this price. It closed underneath the daily 20, and it suggests that silver, based on the CTAs itself, could actually still get down here before it goes into a rally. Now, does that mean that the silver trade is over, the end of the trend or anything like that? No. I see a lot of comments. Please be aware. You guys say heaps of people lost money buying silver. Heaps of people got screwed for years. There is a difference between understanding silver from a multi-decade approach and then just saying buy silver every single day for 10 years straight, like many other silver traders have done. So just remember, no, I still think silver is going to go up overall as long as the economy stays fairly good. And what I think is that most people don't know how to read metals. You know, we've been talking gold this year specifically. It's been one of the best asset classes. Silver will follow gold to a degree. And you've got to just think about it as doesn't matter what happened before. Leave your preconceptions of some crazy person telling you to buy silver for 14 years straight. I don't stack silver that much. Remember, if you stacked silver after the 70s, you would have got destroyed for like decades. So it's very important that we always leave those misconceptions and say, well, what's happening right now? And you might say, well, silver's manipulated. Silver's got that trade on it that we all heard of. Yes, I understand. But it's different when you're thinking about timings. You're not saying hold it for 10 years, that's for sure. Let's move over to copper and take a look here at what's going on from the copper standpoint. Well, we got a breach and then we didn't manage to break and close above. So watch reaction here is a key level. We're still watching on copper, so no metals breakout just yet. Let's move over to Tesla. Tesla sitting at 214. We know 215 is a call wall. I guess if it gets through 215 for the day traders, you might be interested. I had a look at the 2-hour session. The 2-hour session looks a little bit more bullish than bearish, I would say. But Tesla's not really got too much edge on it right now. You may also argue the inverse head or the head and shoulders here with the neckline and this being a flag. It's possible. And of course, if the markets choose to go ballistic, that's pretty much what most of the NASDAQ stocks looks like. Speaking of Nvidia, let's have a look at Nvidia. We can see the anchored VWAP. We can see the market coming down to this key level. We know that this is the first major buy zone. The second one is at 106. So have we really got anything yet? Not really a strong buy off it yet. Daily, of course, just closed a long leg doji, so nothing much. But we know that's the first key level for Nvidia buyers. So if you like Nvidia, and that may be all the dip we get, but we could also get a possibility of a 106. Let's have a look at the HSI. Not a bad close for it overall, I would say. And yeah, pretty happy with the HSI over the last week, making a series of higher highs and higher lows, respecting the 20 moving average, and now putting pressure on the 18,300 level. So pretty good return out of China. And obviously we're seeing Tencent here as well, slowly grinding up, looking for that to start to go a little bit better, because that would be, of course, good. And one of the stocks we spoke about before, which was Baba, let's have a quick look at this on the charts, you'll notice has been improving. Now, I would say, as far as Baba goes, this is probably one of the better charts that I've seen from it ever. However, yeah, it's Baba. Let's move over to the US 2000. Pretty good. Pullback, as expected. Would have liked it to go to 2150. Could still go there, we'll see. But in general, pretty bullish. And of course, Tom Lee is going on and on and on about how he loves the Russell 2000. And of course, the stats do predict that he may be correct here, because we do have the rate cut. We do also have quite a lot of strength coming in from the street, expecting that small caps and mid caps have to improve. And if they don't, well, that's going to be basically what the next earnings about. That's their hype and anticipation. RSP, very strong weekly close. Again, showing that Russell 2000 may start to play even more catch up. And yeah, that's a very strong weekly close. You've got to admit that one. Let's move over to the Qs. The Qs are stuck in range. They're sitting on the daily 20 moving average. They bounced off. They're much weaker than the S&P 500 and the other markets. Maybe They are in a flag. A lot of people are using a flag at the moment. I mean, it is technically a flag setup. So we'll see whether we can get a breach, but there's no real information here about a breach just yet. Similar to the S&P, I guess you have to go more bullish than bearish when you look at what happened on Friday. But yeah, it's not that easy. Now let's move over to Bitcoin. Now Bitcoin is, it's doing interesting things. I'd like it to get back above 60,000 so we can actually see some strength in it. It rallied through this point here, pulled back. I thought that was actually a pretty good buy for Bitcoin. It took out like this little minuscule low underneath here. And you'll notice that it's been a bit sneaky because, of course, there's a few different lows here that you could have gone for. And it's just sitting there. It really does need to find buyers. If it doesn't find buyers quickly, it could use this as effectively a supply zone. People would be shorting it and then weaken off. And that's really going to take us into what we call basically the bad September for Bitcoin. Remember, October, November, December, traditionally incredibly good if we do see weak Septembers in Bitcoin. So we'll do a bit of a study on this one moving forward along with Ethereum, but I don't think there's too much to really go with just yet. The key level I'm looking at is 60K, and then I want to see it above this other high again. But really, above 60K would be a great first sign that the bulls are back in control of the small time frames. Now, this week is shorter, so for anyone in Canada and US, have a great long weekend. Remember, Monday will be very thin on the futures market action. Then we get the ISM manufacturing PMI on Tuesday. Then on Wednesday, we get the JOLTS job openings, and then we scroll through to the non-farm employment change. Now, don't worry too much about the ADP one here. It's the Friday one that matters. I'm sure it won't be a real result, as we know they're always wrong and they get revised, but we are looking at what do the revisions look like and has the Fed stuffed it up. So this will be a volatile event. Currency traders, stock traders, anyone really, this is a big, big, big moment for, of course, what the Federal Reserve is going to do next with its rate cuts. So be watching, and that's at 8:30 a.m. New York time on Friday. If you enjoyed today's video, please remember to subscribe, follow us on some of the other social medias, and also remember the sponsor of today's video, which is Tiger Brokers. Links in the description and pinned comment down below, guys. And if you're from Australia, you do get a few extra bonuses that I've managed to hook you up with. All right, catch you for now. Have a great one.